All right, well, good afternoon, everybody. It is Thursday, February 12th, and it's noon, and we're going to be presenting the PW Johnson Wealth Management Market and Wealth Outlook for 2015, which we're calling the most interesting of times, because it really is. This is an amazing, sort of unprecedented period in terms of society, politics, central banking, economic markets, you name it. We're in sort of a different uncharted waters now, and we're really excited to be able to present this information to you. I want to say at the outset that this represents the views of PW Johnson Wealth Management as of today. That's not meant to be construed as investment advice, and please consult your investment or other financial professionals before you act on any of this. We're not really trying to sell anything, but we will mention perhaps an investment or two along the way, but not endorsing any particular product. The intention of the call is to provide an informative context and a glimpse into our investment thinking, but of course we always like to put a little emphasis on the fact that investments aren't everything in terms of building wealth. During the first half, Michael Gray is going to bring us up to date with recent market developments, which are quite interesting, and during the second half, I'm going to be presenting forward-looking views on forces shaping markets and wealth, and I'm Peter W. Johnson. So as I mentioned at the outset, these are probably the biggest changes in the markets in the 35 years I've been in the industry. We're in uncharted waters, unprecedented central bank intervention, technology disruption. And as usual, we don't have a crystal ball, but we do believe in watching the big picture, including politics, technology, social changes, and changes in our investment industry. I'm going to let Michael start his part to kind of recap what's been going on and give us some context. So, Michael, thank you for joining us.
You're very welcome. Thank you for that wonderful introduction, Peter. Next slide, please, Kent. Okay, great. So, the first slide, you'll see at the top there, despite the recent outperformance of U.S. stocks, the case for global equity exposure remains a compelling one. And this graph illustrates that point. So we're looking on the horizontal axis is time, starting with 1970 on the left and 2015 on the right. And we see dollars on the vertical axis in millions. And we're starting out with $1 million in 1970. And the blue line is a global equity portfolio, and the gray line is the S&P 500. And so that blue line, what does a global equity portfolio represent? And you can see in the small print down there that from 1970 up to 87, we're using a portfolio that's 60% S&P 500 and 40% developed foreign markets. So developed foreign markets is Western Europe, Japan, Australia, New Zealand, countries generally that we would think of as first world countries. And beginning in 1988, what we're adding to that is emerging markets. And some of you are familiar with emerging markets, sometimes known as the BRIC countries. So that's Brazil, Russia, India, China, South Africa, Mexico, Korea, South Korea, Taiwan, countries that are growing quickly, that have younger populations. And what we see there in the blue line is that with this broadly diversified portfolio, that in the long run, we come out ahead of just staying in the U.S. stock markets, which is interesting because, as most or all of you know, past couple of years, the U.S. markets have been up a lot, And the conversation can sometimes turn to, well, why don't we just stay and invest here in the U.S.? What's the point of investing abroad when the U.S. market is doing so well? Which leads us directly into the next slide. Okay, so I almost wish I'd hidden the right half of this slide here, but we're going to start on the left, and we're looking at the time period from 1995 to 2001, and the vertical axis is percent return, and the blue bar shows U.S. markets. Orange is developed international or developed foreign markets, like I was just talking about, and green is emerging markets. And when I first looked at this graph, what I realized is that the period of the past several years leading up to now is very similar to what we're seeing in this time period of 1995 to 2001. So the U.S. market is doing really well. Developed international is not quite keeping up. And emerging markets, in particular last year, were down or flat, depending on the particular investment. And if we fast forward to the next 5 years, we see kind of reverse of this phenomenon. So from 2002 to 2007, U.S. markets are up, not quite as much. Developed international markets are up even more, and emerging markets are up even more. So, which points to the headline of this slide, which is that equity markets go through cycles, and it's unwise to extrapolate recent trends far into the future. And I also want to add at this point that given the financial media, it's hard to get a longer-term perspective when a lot of the media is driven by what's happening right now, what happened yesterday, kind of how to make money quick. And really what we're looking for is a diversified portfolio that's going to treat us well in the long run. And I just want to pause here for a moment and see if there are any questions or comments. I think it makes for a rich experience when there's questions, comments. Everybody learns and everybody benefits, I think, from that.
Sorry, I was on mute. Do you have information that's more recent than 2007 for this kind of information?
That's a great question. I don't right now, and I will do a little research.
Yeah,
go ahead, Peter.
We certainly have more up-to-date information. This is very much paralleling what's been going on. We don't have it for the slideshow today, but this is almost been a replay in the last 3 years. But we will get that to you. Happy to do it.
Yeah, it would help to see more, because we are in uncharted territory, and I'd just like to see if the trend is continuing or it's getting murky or whatever.
Sure.
And I'll be addressing that further on in the call too.
Okay, great, thanks.
Mm-hmm.
Okay, next slide.
Michael, you need to press the button to synchronize slides with phone on the bottom.
I did that from the beginning.
Oh, no.
Okay, I'm up to date now.
Okay.
Okay, 2014. What I'm showing here is performance by country for 2014. And we're starting with green at the top with the top performance. It's ordered in terms of performance, so the best performance is at the top and worst performance is at the bottom. And we see that India had the best performance last year at almost 28%. And down at the bottom, Russia and Greece were the worst performers. And the U.S. is there, I think about the sixth one down from the top at 13%. And as I mentioned earlier, we like to have a broadly diversified portfolio around the world, including emerging markets and developed foreign markets. And we see a lot of our developed foreign markets in the middle there, in those yellow colors, as either a little bit up, flat, or a little bit down for last year. Next slide. Okay, great. I mentioned long-term perspective earlier, and this is really a fun slide to illustrate that point. And I'll take it step by step because there's a lot of data here, and then I'll stop at the end to see if there's any questions or comments. So on the left here is a one-year period, those 3 bars, and the next section is a 5-year rolling period, and then the next 3 bars are 10-year rolling periods, and finally on the far right is 20-year rolling periods. And what we're looking at is stock and bond returns over the time period of 1950 to 2014. So 65-year period, you can see that in the upper left corner there. And for those of you who are not familiar with a rolling return, what a 5-year rolling return means is that first we're going to look at 1950 to 1954. And then the next period is 1951 to 1955, and then 1952 to 1956, and so on like that. So it's an overlapping time period in order to look at the data. So we'll start with these first 3 bars on the left here. And the green bar is stocks, and what that green bar shows is that for any one-year period, from 1950 to 2014, the worst you would have done in any one year is losing 37% over that whole 65-year time period. And the best you would have done, just in stocks, is up 51%. So that's stocks in green. And in blue, we have bonds. So now we're reducing our volatility a little bit. For any one-year period, the most you would have lost in bonds is 8%, and your best year would have been up 43%. And the gray bar shows the 50-50 portfolio of stocks and bonds, and combining those together, for a one-year period, the worst you would have done is down 15%, and the best you would have done is up 32%. Now I'm going to move just to the right to the next 3 bars, and this is that 5-year rolling period that I was talking about before. So again, we're looking at like 1950 to 54, and then 51 through 55, all the way up through 2014, and we're averaging all of that data together. And what we see there is that with stocks in green, worst you would have done is lost 2% over a 5-year period, and the best you would have done is up 28%. So compared to the one-year period, for green stocks, we are reducing our volatility by hanging in there for 5 years. We're not going to get the max of 51%, but we're going to avoid that 37% loss, which is a good thing. And with bonds, just to the right there in blue, we see the worst in a 5-year period would have been down 2% and then up 23%. And then in gray there, we have the 50-50 portfolio, half stocks, half bonds. And now, for any 5-year period with a 50-50 portfolio, we never would have lost money. Worst we would have done is up 1%, and the best is up 21%. And I'm just going to make a comment now about the whole graph. If we kind of step back a little bit and just broadly look from left to right, what we see is that these ranges are narrowing over time. And for the sake of time, I'm going to skip the 10-year rolling, and I'm just going to jump to the 20-year rolling. But the way the data is constructed and displayed remains the same. So now I'm on the far right part of the graph for those last 3 bars. The green bar, again, is stocks. And now we're looking over a 20-year period. If you had been completely invested in stocks, the worst you would have done is a 6% return, and the best would have been 18%. For bonds, not quite as much, up 1% in the worst case, and up 12% for the best case. And finally, on the far right, for that diversified portfolio of 50% stocks, 50% bonds, worst we would have done is up 5%, and the best is 14%. And I'm going to pause there for a second because there's a lot of data here, and I want to see if there are any questions or comments about that.
Michael, I've got a comment.
Yeah, great.
This range of data goes from 1950 through 2014, so 64 years, and that includes some very, very dicey periods in the markets. In the early 70s, we had the oil embargo. We had a big decline in large-cap U.S. stocks, 73, 74. And again, in 1980, we had very high interest rates. We had stagflation. We had great levels of inflation. And markets really struggled. We had a double-dip recession in 80 and 82. And this takes into account those older crises, as well as the 2000-2002 tech bubble collapse and the 2008-2009 Great Recession. So I think this gives some perspective in terms of the reason that we call stocks long-term investments, for example, and the benefits of diversification and looking at the longer term.
Yes. Yeah, what I'm getting from what you said, Peter, is really the wisdom of hanging in there in the market and riding out that volatility over time. Next slide, please.
Oh, sorry, I do have one question. Was the data based on U.S. stocks and bonds only, or a more global perspective? Oh, okay.
It's U.S.
Thanks. Okay, thanks.
Sure. Any other questions, Linda, or comments?
No, thanks.
Okay.
I appreciated Peter's comments. That helped put it in perspective.
Oh, good.
With all of the history of volatility in the past, we're thinking more, today, the crazy things that are going on today. But it has been a rocky course at times in the past. Yeah. Yes,
definitely. And so I'm going to shift directions a little bit here to interest rates. And for those of you who have been following interest rates, for about the past 30 years, from the 80s when interest rates spiked with inflation until now, they've been on a steady downward course, which is sometimes called the 30-year bull market for bonds, because as interest rates go down, the value of the bond or the price of the bond goes up. And anybody with a bank account who's been watching the interest rate there knows that they're earning almost nothing on that interest rate. And so what happens with that is that people go chasing for yield. It's called yield chasing or looking for income. And so there are a lot of different ways that people have gone after that to try to, because with your bank account, you used to be able to get 3%, 4%, 5%, and that's just not happening anymore. And so people are taking on additional risk in different ways to try to get that yield, to try to get that interest. And one way people have been doing it is through going further down the credit ladder. So investment-grade bonds used to pay well, and now they don't. And so people are going more and more into junk-rated bonds to try to get that higher yield. And another way they're doing it is looking for the dividend yield, and that's what this slide here shows. It's showing the dividend yield on the S&P 500 over a very long time period. On the left, starting back in the late 1800s, and then going through current time. And the vertical axis shows the percentage yield. So, for example, if Apple's trading at $100 a share and it pays a $2 dividend annually, that's a 2% yield, because 2 over 100 is 2%. And so it's been a popular strategy to buy dividend-paying stocks. And so what happens with that is since Apple does pay a good dividend of 2%, for example, people are going to buy that stock, and let's say the price gets bid up to $200 a share instead of $100 a share. Well, the dividend let's assume the dividend remains the same at $2 a share. So now we have $200 a share divided by that $2 dividend, and now our yield has dropped down to 1%. And so that's what we see in this graph here, is that over time there's been a gentle, steady downward trend in the S&P 500 dividend yield. Okay, next slide. Okay, now we're back to our color-coded list here, and you may have to get up close to the screen to see these numbers, but I'll describe them also. One of the big things we look at when considering investments is valuation. And one of the most common measures of valuation is the PE ratio, or the price-to-earnings ratio. So, again, using Apple as an example, if Apple's $100 a share and it earns $2 a share annually in profit, then 100 divided by 2 is 50, and that's the PE ratio. And what this slide shows is the average PE ratio by country for the companies in that market. And instead of just a static PE ratio, because if we look at a static PE ratio, it's going to be fairly volatile based on the company's earnings and the company's stock price. But if we average those PE ratios over the past 10 years, we get a more stable measure of how valuations are doing. Because averaging over a 10-year period, it's going to smooth out those smaller variations. And what we see here at the top is Greece and Russia with PE ratios of 3.8 for Greece and 7 for Russia. So those markets, according to PE valuations, are inexpensive. They're a bargain. And at the same time, we might not be ready to rush all of our personal savings into Greece and Russia, because it comes with increased risk, it comes with increased volatility. There's a whole lot of issues at play that Peter's going to go into. So maybe not all our money in there. Do we want to put a little bit in there? Perhaps. And now I'm going to look at the other end of the spectrum. And if we look down at the bottom there, second to the bottom is the USA with an averaged 10-year PE ratio of 25.4. So on a valuation spectrum, that means the U.S. market on average is very expensive. So to buy $1 of profit in the U.S. costs much more than buying $1 profit in Greece or Russia. And so when we look and think about forward-looking investments, the PE ratio is a great place to look. And given our long-term goal of buying low and selling high, buying in the U.S. now, most people wouldn't consider that buying low, given the PE ratios. And I'm going to stop there and see if there's any comments. If you have comments, Linda or Peter, if you want to jump in with some additional ideas. What we're looking at on this slide is called the Schiller PE ratio, which is another term for the 10-year averaged PE ratio I just described. And on our last slide, we saw that the U.S. PE ratio was 25 or 26. And what we're looking at now is the time series over time of that 10-year average PE ratio just for the U.S. market. So that's what we're seeing in green here. And the historical mean is 16.6, and we can see that now PE ratios are high for U.S. markets. And if we go back in time in the graph to 1929, we can see that that PE ratio was high then. And as we all know, there was a big market crash then, followed by the Depression. We also see that this PE ratio was really high in 2000, which was followed by a big drop in the S&P 500. And it's interesting because Mr. Schiller, who developed this, says it's not really a way to time markets, but it can show when we're at extremes. when we're moving to extreme ends of this ratio here. Okay, next slide.
This is going to be where I take it back.
All right. Thank you, Peter. Take it from here.
Thank you, Michael. That was very nicely explained.
Thank you.
Very clear. This slide is a quote, and I really like it because one thing that does not change over time, we're not in uncharted waters when it comes to human nature and the behavioral biases of our minds. This quote is, if you let the market make you feel high or low, you will lose money. And what it's pointing to is when things go up in value, that's when everybody gets excited. And it's kind of strange that people get excited about high prices and want to buy stocks when they would do just the opposite at the local supermarket, where we look for a sale and then we get excited and we want to buy because we know it's costing us less. But the human mind has something called recency bias. It says whatever's been happening recently is what we expect to keep happening. And it makes sense in most of nature, but not so much in investment markets where people are already trying to anticipate the future. So if you get excited when stock prices go up and you buy, that's probably just the wrong time and you're likely to lose. Or if you get depressed when prices go down and you sell, that's also a bad move, obviously. It's very simple, buy low, sell high, but very hard to do in practice. Very, very hard to do because everybody is optimistic or pessimistic at the same time, and we pick up emotions from other people. So things may look like they're falling apart, and we are in uncharted waters. It doesn't mean they're going to fall apart. It just feels that way when we're going through transitions. Life will go on. Commerce will go on. Markets will continue to exist. There are a few folks who think we won't have money anymore and things like that, but I think we're in for big change, but not quite of that magnitude. So the next slide, I want to talk about some of the big things that have been going on recently that are really quite exciting. And the price of oil has been collapsing for about 6 months. And this chart goes back to 1985, and the gray bars vertically are different recessions. This is a huge drop in oil prices recently from about $100 a barrel down to about $45 a barrel. And if I didn't have any other information, I would look at this slide and say, my God, we're going into a recession, and it's going to be a big recession. But there are other factors at work that are also unprecedented, including the fact that the U.S. is producing more oil than we ever have. Well, I don't know actually if we're at that point, but we're producing a lot more than we did, and we're providing about 60% of our own oil needs. So we have an increase in supply, and U.S. drivers in particular are not driving any more than they did during the recession. For some reason, driving has not picked up. So demand has been a little weak, while supply has been strong, and that indicates that we should expect dropping prices, especially in something like oil, which is not easily replaceable. You can go out and buy an electric car next year, but you're not going to do it, over a short-term period. People are still using gasoline cars, and they can't just switch to gasoline again when the price drops 50% in 6 months. So what we say is the price is very elastic compared to the demand. The demand is kind of fixed, somewhat flexible, so the price has to give way when supply and demand get out of whack. This is a trend that helps consumers, obviously, and it's put extra money in people's pockets. But at the same time, it hurts suppliers. So it hurts oil companies and the suppliers to oil companies. There have been some layoffs there already. Certain countries import a lot of oil, like Japan. Others export raw materials, particularly emerging markets. So it's kind of a mixed bag. It affects some more than others. And perhaps the most important point is that instability in something as central to the marketplace as oil can be unsettling to markets, especially when it's not expected. So one of the things that's happened is that there are a lot of junk bonds that are issued by oil companies as a percentage of total junk bond issuance. And because those weaker companies have been affected by the drop in the price of oil, they look riskier and the prices of their bonds have been dropping. Could that lead to people rushing out of those risky bonds and into safer ones? Could it spread to other financial sectors? It could. I don't think it will, but this is the kind of thing that happened in housing not so long ago that did affect other sectors. So the price of oil collapsing, and then the next slide. Really, the biggest issue in the last several years has been central bank activity. We've all heard about zero interest rates, and that's the reason people have been pulling money out of banks and going to bonds and stocks and riskier things, is because the Federal Reserve has lowered interest rates to zero. And then they went further than that. They started to buy bonds to reduce interest rates on bonds, particularly mortgage bonds, to help the housing market recover. So interest rates have been dropping thanks to central banks and to their quantitative easing. And quantitative easing is just a name for lowering longer-term interest rates in bonds. And you can see that it isn't just the U.S. on this slide. The blue line is the Federal Reserve, and we've kind of leveled out since last year. We don't expect to be expanding or continuing this quantitative easing or this printing of virtual money. On the other hand, Bank of Japan, which is the red line on a rapid upward slope, has sort of set out an unlimited quantitative easing program. And Europe, just this last month, decided to begin quantitative easing to lower the euro and increase exports, because when you decrease interest rates, there's less demand for the currency, and the currency falls. When the currency falls, you have a price advantage when you're selling something, exporting something. And also they want to stimulate internal borrowing and lending and get out of what's called deflation, the threat of deflation, which is very hard to deal with when it occurs. So the central banks of the other major economies of the world, Europe and Japan, are becoming more liberal while we're beginning to tap on the brakes. And what happens is that stock market volatility tends to increase as monetary policy begins to become less easy or if rates are about to rise. So it's one of the main reasons we're seeing volatility in U.S. stock prices. In January, 14 countries cut rates or loosened borrowing standards. So we're running against the grain now if we do start to raise rates. This is also the reason that the U.S. dollar has surged lately, because the prospect of higher rates in a secure currency is very attractive versus the other currencies where rates have been dropping. And a lot of this is very unpredictable because it's set by, say, a board of governors of a central bank. An example of the unpredictability here is that the Swiss National Bank surprised markets by unpegging the Swiss franc from the euro a couple weeks ago, and the Swiss franc rose 20% in 24 hours. Totally surprised everybody because they'd been saying, no, we're going to maintain this peg, and then one day they said, no, we're not going to do that anymore. So very difficult. So it points to the need for diversification and not counting on any one strategy. There's this extra central bank risk, which has been a large driver of markets, but also what they give, they can take away. So I'll pause there and see if there are any questions at this point. Okay, good.
Not
move
for
on.
me unless you can fix it.
Unless I can fix it.
Yeah,
well,
right.
It's been very good for investors since 2008 because they've driven up the price of stocks and bonds, and we've never been big CD holders or money market. We haven't hidden out in money markets, so it's been very good for investors. And personally, I think we would have probably had a depression had the central bank not come in with easing in 2008. So, and it hasn't been fair. It totally has not been fair, but it was the major infusion that the markets needed to stop the headlong dive into economies just going into a total free fall and not functioning. So it hasn't been all bad, but it does create more uncertainty. One thing that it does, too, is it tells us that when things get really bad, the central banks are going to step in and kind of rescue things. So in a way, it's kind of comforting, too. However, we've been drinking at the punch bowl for a long time, and it might be time to sober up a little bit.
That's my fear, yeah.
Kind of gotten addicted here. So the next slide. Just in the last few weeks in Europe, the recent quantitative easing has driven rates below zero in some of the European economies. It's really quite pronounced. This chart shows a number of different countries, about 15 countries, and it shows that's on the vertical axis. On the horizontal axis, it shows maturities of different government bonds from 1 year, 2 years, 3 years out to 10. And the green boxes are positive interest rates, and the red boxes are negative interest rates. It's hard to believe, but about 40% of the government bonds in Europe now, ranging out to 10 years, are yielding negative interest rates. In Switzerland, you can go all the way out to a 10-year bond and still have a negative interest rate. Denmark, Austria, Germany, Belgium, Finland, France, Netherlands, Sweden. This is unprecedented. This is uncharted territory. In this country, we've been talking about, bonds are close to zero. They can't go any lower than zero, so they've obviously, if they're going to go anywhere, rates are going to go higher. Bond principal is going to go down. Well, this tells us that zero is not the lower interest rate bound. We don't know how low it can go, but I have a couple of interesting things to share. I have some quotes, so if you don't mind me reading a couple of sentences here. It's from the Wall Street Journal a few days ago. In Denmark, banks are flipping the tenets of the banking industry on their head. After the Danish central bank recently slashed its benchmark interest rate to well below zero, several of the country's lenders have followed with highly unusual moves of their own. On Friday, FIH Ervis Bank announced plans to charge retail customers to hold money in their deposit accounts, the first Danish bank to do so. Paul Nordahl, which is FIH Ervis Bank's chief financial officer, said, "If people want to put their money with us in our deposit bank, we at least don't want to lose money on it. Paying our customers zero or positive interest is very bad for profitability." So the bank is able to borrow from the central bank there at negative rates. They can't afford to pay positive rates, so it's got this ripple effect going on. In some cases, Danish mortgage lenders to people who are buying houses have seen rates fall to the point that the mortgage holders are only paying lenders because of fees charged on top of regular interest payments. Yeah. So we have zero mortgage loans over there. Denmark's central bank has cut rates 4 times since the start of this year to minus 0.75%. So it's more than just a blip below zero. The bank is scrambling to defend the country's long-standing peg to the euro. They're trying to maintain their currency equality so that they don't so that the Danish currency doesn't rise, and they would lose their ability to export as much as they do. So this is kind of a race between countries to have lower currencies or less valuable currencies, because that's healthier for your manufacturing and your exports. So quite a remarkable world we're living in. Negative interest rates. How far it'll go, I'm not sure. And people say, well, who in the world would buy a bond with a negative interest rate? And it turns out that some people think that's a good bet, because if interest rates drop even further into negative territory, their bonds will go up in value and they might get capital appreciation. No interest, but maybe capital appreciation. So interest rates, central bank policies diverging. Next slide. Poor Greece. They decided on December 9th to call for a snap presidential election, and they elected a government that thinks austerity is a four-letter word, and they think they should be given a break. They're kind of like the homeless country, I guess. Austerity's been very painful for them, and their unemployment rate's extremely high. So they're saying we aren't going to pay our debts. And, of course, the European Union and European Central Bank is saying, well, we'd really like you to pay your debts because we don't want to start a new precedent that says you don't have to pay your debts. That's not going to go well for us and for our union. The current bailout agreement for Greece with the Eurozone is 240 billion euros, or about 180% of the GDP of Greece, which is a huge debt. That ends at the end of February here. So there's a lot of uncertainty, a lot of scrambling. They have not reached any agreements. And then the big chunk of debt comes due at the end of June for them, so they're really going to have something by then. You can see the value of Greek banks falling pretty precipitously here. They've fallen 60%, the stock of the banks, since December 8th. So pretty dramatic. And people I'm reading say there's a small chance that Greece would leave the Eurozone. 76% of the Greek people want to stay in the Eurozone. A similar number don't want to pay their debts. So it's kind of a mixed bag. But it is a worry for financial markets. It would be very disruptive to Europe, and it would Greece interest rates have been rising. Fortunately, it hasn't spread to Italy like it did in 2011. Other countries still have low interest rates. If they can contain it, it will be healthy for the union over there and for their markets as well. Luckily, we don't export a lot. Exports are only about 14% of our economy, and only about 12% of those exports go to Europe. So we're not terribly dependent on them. But when you only have a small growth in GDP like we have right now, it does matter. So the next slide shows how strong the dollar is. The dollar was very strong back during the financial crisis several years ago because it was seen as a safe haven. It is now at levels that are quite a bit above those reached during the crisis. And like I was saying before, a strong dollar hurts our exports. It also hurts our companies that sell most of their goods abroad, like Apple. I think 76% of their sales are abroad. And it's deflationary. So that means to the extent that we import goods, and we import more than we export, those prices are going to be cheaper in dollar terms, which drives down our cost of living. And that sounds very good. I certainly don't have any argument with it per se, but it may constrain the Federal Reserve's ability to raise interest rates here, because when they do that, they may push the dollar up even further. So the Fed is planning to raise our interest rates and go back into that tightening cycle in June. But if our employment rate doesn't improve enough, or if the dollar is too strong, they may have difficulty. There might be some practical reasons why they would want to delay raising rates. So these are things that we're watching as well. Plus, whatever goes up comes down, and eventually, when the dollar reverts to more normal valuations, that'll be very good for people who own foreign stocks and bonds. It's been a headwind for us for the last year or two, but it could become a tailwind. Next slide. See if I can get through all these before 1 o'clock. Volatility is back. This is a 10-year chart, but you can see that recently there's been a pickup in volatility. This is a VIX average, which volatility index measures how much up and down movement there is in the stock market from day to day in the U.S. And it's a very direct measure of how bumpy the road is getting, if you will, and it's now above its 10-year average since last October. So we don't expect things to be as smooth as they have been for a lot of reasons, particularly the shift in central bank position in the U.S. Next slide. And then our favorite, political uncertainty, which certainly includes the central banks, although they're not politically tied to voters, but they are involving people and decision making. In the U.S., we have a new budget proposal and tax uncertainty, as always. Lately, there's been talk about limiting access to 529 plans for wealthy people. There's been talk of a limit on the maximum allowable in retirement plans for wealthy people. And there's been the introduction of a new kind of retirement account for people that are employed and not covered under a company plan. Relatively small, but all of these things point to this concern about economic inequality, which is very wide, and it was widened by the central bank actions, which made investors wealthier but didn't help the common working people as directly. I think it will over the long run, but there's a lot of concern about economic inequality throughout academia and throughout the investment world, and everybody's pretty much in agreement. We can't have too much economic inequality or else we have social upheaval, and obviously that's not good for anybody. So there's a lot of talk about helping the poor, taxing the rich. So this could have other implications. I think that'll tend to ease a little bit. I think economic inequality has increased lately, but it may start to come down a little bit with more people going back to work, which is beginning to happen. Also, we have global conflict. Markets hate uncertainty, and the whole thing with the Ukraine and ISIS and the Middle East, that kind of stuff can escalate very quickly and divert attention and resources and put strains on countries' treasuries. I visited Versailles once, the Palace of Versailles, and in the, I forgot what they call it, the golden room with gold. Everything's just painted gold now. Originally things were actually gold, but the king had to sell stuff out of his own palace because they were running short of money to fund their wars over there. Very graphic example of the cost of war. And also we have healthcare uncertainty. The Obamacare Affordable Care Act is back again in front of the Supreme Court being tested. We just saw a gentleman yesterday who his big concern about retiring is will he be able to get health insurance? And so he's got to kind of keep an eye on that to decide when to retire. Otherwise, it would be simple, and we don't know what to count on here in this country. So a lot of political uncertainty. adding to the mix of interesting factors we're dealing with in the next slide. So some of the things we're watching are the employment rate in the U.S. We think that supply constraints and increasing demand for employees may finally give us rising wages. You know, there's been so much slack in the market that employers have been in the driver's seat for a while, but we may see that shifting at this point, which would be good news because we all benefit when more people are working and there's more goods and services available. But it also means that the Federal Reserve could get back to operating more normally. And, of course, people's confidence rises, too, so it's all good. We're also looking at this fine balancing act between inflation and deflation. It's interesting that printing all this money in the last few years has not resulted in inflation, mostly because the dollars are just sitting in banks. They're not being used. But if they start to be used at an increasing rate, we could see inflation. Deflation, again, is a difficult scenario for central bankers to deal with, and it seems to be right on the edge in Europe that they're looking at possible deflation. We're not looking at that here at this point. Rising interest rates obviously affect bonds directly. It'll affect stocks as well and currency exchange rates. Then we have technology disruption, which is having a huge effect on jobs and industries. Newspapers used to be a great business, and then we had more and more classifieds online, and now newspapers aren't such a good business. We saw it in music. We see it in the taxi realm with Uber, which is now valued at $41 billion, and Airbnb, which doesn't own the rooms they rent out, but they rent out more rooms than any other major hotel chain, and they're growing very, very quickly. So there's sort of a revolution going on with these upstarts stealing business away from these established business models, which is really interesting. It may lead to increased standards of living because we're using assets more effectively, but it may be trouble for the established industries. And then we have something really radical further out on the horizon, but certainly the potential to be a game changer, and that is cyber currencies like Bitcoin and payment systems like Apple Pay. Bitcoin is a big deal in emerging markets. There are lots of venture capitalists helping businesses start in third world countries where Bitcoin is more readily used. They don't go through the banking system as much as we do in the developed countries. They can pay each other directly. It's more flexible and maybe more trustworthy, more transparent. But obviously, if we're invested in dollars and some other currencies begin to become prominent players, we're going to be looking at that and seeing how we can participate and protect our investors. And the next slide is a few interesting investments we're looking at. We continue to look at passive versus active, and I'm going to go kind of fast because we're running out of time. Actually, let me just skip over that completely. We have a quote from Charles Schwab and Company just a few days ago. We believe global diversification is becoming increasingly important in a more fragmented and divergent global landscape. So many analysts, including Schwab, are neutral to slightly negative on the U.S. stock outlook, and most of them are overweight on emerging markets, which is something we've been doing. Then the next slide show the 10-year expected returns for several different investment markets. Sorry to go so fast over this. You see here colored bars, and on the vertical is the percent return that we expect for each of the next 10 years on average. And going to the right, we see different asset classes. Way over on the right, there's a red bar that's not very tall, and that's U.S. large cap stocks, which have been doing the best of all the asset classes the last 2 years, with perhaps the exception of biotech and real estate, which are actually subsectors. But U.S. large caps we expect to earn less than 1% a year after inflation over the next 10 years because they're starting at such high valuations. Whereas way to the left there, the highest bar is EM equity, which is emerging markets stock investments. They have higher growth rates in their economies. They're selling at cheaper valuations to start with. They don't have a lot of debt piled up in their economies like Europe, Japan, and the U.S. to impede their progress. And we're looking at perhaps something over 6% a year in real return after inflation over 10 years. And everything in between, the second red bar, EAFE equity, is the developed stock markets like Europe, Japan, but outside of the U.S. at about 4% a year. Commodities are one of the better performing forward-looking classes probably because they're again starting from a low base and sluggish demand. It's pretty much what we always do. We're really strong believers in diversification. Sometimes those things that have been doing well are the next things that do so poorly. And I can remember very well how people lost tons of money in the tech meltdown. We heard another story yesterday about that was heartbreaking, really, how quickly wealth can be wiped out when it's concentrated and when things go awry. We're looking for quality investments. We're looking for high-quality companies, high-quality bonds. We're looking all over the world. We're looking to keep costs low. And we tend to tilt a little bit towards value. So we tend to tilt towards the cheaper things out there because there's less downside and more upside. We screen for great managers, whether it's in our active funds, where they're choosing the industries, the countries, and so on, or they're running the passive funds with some kind of strategy that may be designed to do slightly better than the indexes. But we're looking for people who are smart and consistent and ethical that run the investments that we put our clients into. And we always focus on the human element, knowing that it plays such a big role. You can be as rational as you want in the investment markets, and in the short run, God help you, really. People will all head to the same side of the boat at the same time. They will tend to buy when things are high, and if you chase them, you don't want to be the last one buying something. You don't want to be the last one selling things either. You want to be kind of buying things when they're low again. And we want to make sure that we hold your hand through the ups and downs so that we're not tempted to let the emotions run off with us. The final slide is next. Actually, there's one after that, but feel free to share this presentation with friends or accountants or other advisors. We're going to be doing some new kinds of presentations this year. We don't have dates yet, but we're going to talk about elder care issues in one of the presentations. We'll probably have our friend Jim McCabe, who's an elder care specialist, talk about those issues. They come up quite a bit, and unfortunately people often don't look at them until it's kind of the last minute. So it's good to look at those things early. What are the living arrangements? What are the costs? How is this going to work out? We have a plan. Secondly, we'll probably look at estate planning in some depth from a number of different perspectives because a lot of people don't have estate plans done. We'll probably talk about kids and money, a little bit about how to avoid raising spoiled kids or entitled kids, but getting them off on the right foot with good money habits, knowledge, and an exploration of values, both the parents' values and the kids' values. And finally, we may have a presentation on financial pornography, which is really what we see in the news every day, the advertisements, the daily stock market coverage. It's pretty hilarious when you look at it from a distance. And we saw a very funny presentation by a gentleman from the Dimensional Fund Advisors. We're going to invite him and see if we can get him to do a presentation for our clients. It is just really entertaining. And if you have any questions or suggestions about this presentation or for future presentations, feel free to call us or email us. We're always happy to talk to you. And the last slide is where people can get hold of us.